Hello? Alright, before I say about hedge funds, I'm going to jump right into it. This is John Paulson's $53 million Colorado skiing ranch. He's worth $12.5 billion. This right here is Daniel Loeb's $52 million super yacht. He's worth $1.5 billion. And this is Stephen Cohen's $64 million William de Kooning painting, which he bought recently. And he's worth $8.8 billion. So you're probably asking, what do these billionaires have in common? Well, John Paulson, Daniel Loeb, and Stephen Cohen, they're hedge fund managers. Now, most people have probably heard what a hedge fund is. Most people don't really know. I'm sorry, they've heard of the term hedge fund and probably don't know what it means. So let's start here. John Burbank, he's a hedge fund manager of a hedge fund called Passport Capital, and he defines a hedge fund as an incentives-aligned, risk-seeking vehicle that can encompass virtually any investment strategy under any market condition. Now that's gibberish, so let's simplify things. A hedge fund is a pool of money, first of all. That pool of money is managed by an individual and usually a team. And depending on that hedge fund's investment strategy, that individual and his team, they may invest the money in traditional assets. You guys have heard stocks and bonds, that kind of thing. Or they might go the more exotic route and invest in things like currencies. You can trade Japanese yen, British pounds, or commodities like gold, oil, and even sexier things like options and futures, which I'm not going to talk about, but you know. Now, the money in a hedge fund comes in a couple places. For one, you have the manager, that's me, who I may invest a portion of my own wealth in the fund if I want to make money, and also it's important to show that my interests are aligned with my investors, you, my investors, because I'm trying to show that my money's a risk as well as yours. On the left, you have accredited investors, wealthy individuals, people who can show that they have a worth of at least a couple $1 million. And then you have institutional investors. You have, which is university endowments, pension plans, that kind of thing. And so hedge funds make money for the manager and the individual a couple ways, through fees. Fees. You have one fee is kind of a general management fee, you take it off the top, which means that just for showing up to work, this guy's going to take a lot of money from you. But he's going to make you a lot more, so don't worry. And that's usually 1 to 3% of assets under management. Then you have the performance incentive, which is usually 20 to 50% of profits. So the biggest fund right now is Ray Dalio's Bridgewater Associates, and that fund manages $140 billion, which means that this guy pulls up in his nice car, he comes to work every day for a year, and just because he comes to work, he's going to earn his fund a couple $1 billion. Now, a lot of that's going to go to him, a lot of it's going to go to his team. So let's have another example. You have a $1 billion fund, it makes $200 million in a year. You take 2% of $1 billion, that's $20 million. Then you take 50%, let's say 20% of $200 million, that's like $40 million. You have $60 million that year for that fund. Now, hedge fund managers they're increasingly kind of the titans on Wall Street. You know, they're the new Rockefellers, the new Carnegies of our age, the new Vanderbilts. And so they are really the new elite. You know, they're increasingly called up by the federal government to talk about interest rates for advice on financial regulation, you know, economic growth, anything like that. And so I wanted to find out what makes a successful manager. You know, these guys are so powerful, they make their clients so happy and so rich, and so seeing as I would love to be a billionaire, I wanted to find out what makes these guys tick. So I used some connections of mine, and I interviewed a couple guys. For one, Whitney Tilson, he's a hedge fund manager of Case Capital. And Adam Joff, director of the Boston Company's asset practice. And so I asked them questions like what made them effective at what they did. Do they have any investing role models? You know, are there any mantras, principles, things that they stress with their investment team every day? And of course, I read a lot of books. I read a ton of books. So I came up with 5 must-haves for a hedge fund manager. And those 5's: patience, adaptability, or flexibility, guts, connections, and a good business sense. I'm just going to go through these one by one. Hopefully I can do this quick enough. This is a chart of the Dow Jones Industrial Average, which is basically, if you don't know, it's kind of a market snapshot. It includes companies from every market sector, communications, retail, that kind of thing. So it tells you exactly how the market is performing, or not exactly, but it's a guesstimate. And this illustrates why you can't see it. Okay. This illustrates a basic principle that the market tends to go up. This chart's, you can't really see the actual chart, but it goes up over time. And the best investors, they utilize this really simple principle in that they think for the long term. They invest, hedge fund managers and investors, they look for investments that are going to double, triple, restore fivefold over, 3 to 5 period. They're not looking to time the market in a couple of weeks. They're patient. One of the most patient investors of all time, you guys probably heard of Warren Buffett, aka the Oracle of Omaha. And he used to say, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. He loved to say that his favorite holding period for a stock was forever. He would love to see a stock go up and up, a company continue to perform. And then we have flexibility or adaptability. Now, the market is always changing. A hedge fund manager may have been raised investing in a specific way, a certain culture on Wall Street. Maybe he was a stock picker. But to survive over the long term, any great investor or hedge fund manager has to be willing to adapt, to explore opportunities he hasn't looked at before. James B. Rogers, he was a hedge fund manager back in the day. And he said, be aware of change, buy change. You should be willing to buy or sell anything. Some people say, I can never buy this stock. I can never buy current stock. I can never buy utilities. I can never buy commodities. You should be willing, you should be open and alert to investing in anything. Take, for example, George Soros. He's the wealthiest manager in the business. I think he's worth around $20 billion. He started out Wall Street in his early career. He was a stock picker. That's what he did. He analyzed companies. He bought stocks. He sold them. And let's cut off. Okay. So his first funds kind of relied on his ability to stock pick. That was his thing. But as he had bigger name clients and he wanted to make more money for his investors, he knew he had to explore other opportunities. And so he became a currency trader. And some of the biggest trades of his career were with currencies. As I explained before, you can sell British pounds. It's kind of complicated. I can talk about that after in the Q&A. He once earned $1 billion in a day trading currencies. Guts. The best managers have to be willing to take risk. They have to be more concerned with making money and less concerned with losing it in order to perform. Mark Yusko he was the former director of University of North Carolina Chapel Hill's endowment. If you guys know, an endowment is basically a portion of a university's tangible wealth that sometimes universities invest. And so he would often invest in hedge fund managers because he knew that they would take the risk necessary to generate the kind of great returns he was looking for. And so he would never invest with anyone who was simply trying to preserve capital. He wanted someone who was going to take those risks. So he said, I don't hire these guys to be conservative. I hire them to take risks, educated risks. For example, David Tepper, he's manager of $14 billion Appaloosa Management. And he thinks that his competitive edge really lies in the fact that he's willing to step into danger in the market. Wall Street analysts may hate a company. They say this company's going nowhere, but he would love to say, you know what, there's a potential in that company. I see the potential in that company, so I'm going to invest in it. It's trading so cheaply because everyone hates it. So he would step in the way of fire, and that's how he performs so well. He once said, we're not afraid of the downside of different situations once we've done the analysis. Some people are afraid of losing money, which keeps them from making money. In 2008, following the financial crisis, when everyone was licking their wounds after sustaining huge losses, including himself, he went all in that year. He bought everything so cheaply because everyone was so scared of investing in the market, so everything was trading at such a discount. The next year, he earned his fund $8 billion. It's a record gain. And he took home $4 billion that year into the bank account. That was his annual salary for 2009. Fourth, connections. The financial industry is really one big network. And the best investors, the best hedge fund managers, they utilize this network to find more investment ideas, to avoid losses, make more money. I interviewed Gerard Getz. He was an analyst, senior analyst at SAC Capital, which manages 14 billion, I think, something like that. And he said, the best managers gather information from other funds and other managers and find out best how to focus their time and money. There are over 60,000 publicly traded companies worldwide, so it can be hard to know really where to direct your attention. So having a network of people can really help you find out, what's the hottest sector, what's the place I should be looking, where's everyone paying their attention to. He would often call up a friend at a fund called Carousel Capital, a longtime friend of his, and he would ask things like, what do you think about this company XYZ, or what have you guys been looking at recently? Julian Robertson, one of the most famous hedge fund managers of all time, and long running, he was known for his social investing style. He was known as a Southern charmer. And he would often, be on the phone with people asking what they thought. If an analyst pitched him an idea for a stock, I think we should buy this company, he would soon be on the phone with the CEO from that company. He would get the inside information, not legal information, maybe sometimes, but hopefully not legal information. And then fifth, the best hedge fund managers, they're business people. And the meaning of this is twofold. For one, they're focused on their reputations and establishing strong client relationships. I interviewed Dr. Paul White of PNC Wealth Management. He's a friend of Mr. Canosi, who's not here right now. And he said the best managers are focused on client money and a growing business. You can be the smartest guy in the world, but if you don't have a name for yourself, you don't have a good name, you won't be in business for very long. A strong reputation is incredibly important. Now, even the best funds have losing years sometimes. And these relationships, they really keep people from pulling their money out of their fund. You lose someone's money, 20% of someone's money, why would they stay with you? Well, they're going to stay with you if they trust you. They know you're going to come back even stronger than before. And so, years when you don't perform, your business has to carry you through to at least preserve capital, the very minimum preserve capital. Dr. Paul White also said that. Now, the second meaning in this business sense I was talking about is on the investment side of things. You want to think of buying stocks as really purchasing companies. You don't want to think of them as a balance sheet or as a chart. You want to think of them as a company that you really believe in, that has a future. So Warren Buffett once said, I'm a better investor because I'm a businessman. He was known to invest in long-standing, proven companies that kind of screwed up so he could get them cheaply, but he knew they had potential to grow and expand. And then I interviewed Whitney Tilson, I mentioned earlier, manager of Case Capital, and he reiterated what Warren Buffett said, and he said, think of investing as the purchasing of companies rather than the purchasing of stocks. So what do I do with this information? I started my own hedge fund. I call it Schumer Asset Management. I know you guys will probably invest in that, right? And with these 5 characteristics in mind, I invested in several companies. Some my own money, some from family and friends. So I decided on a long-term investment horizon. I wasn't trying to time the market, make money in a few weeks. I was investing in companies that I knew down the road, or I thought down the road, would have great potential. I decided to diversify. I wasn't going to limit what I invested into just things that I knew about. I was ready to be flexible, to read about other market sectors and invest in the best companies in those sectors. I'm a car guy, so I know a lot about the automotive sector in the market, but I wasn't going to invest in 5 auto companies. That would be stupid. I wasn't afraid to increase, this goes along with the guts, I wasn't afraid to increase a position of mine if the opportunity presented itself. This means that, say I own a stock and it's trading at $15 a share, and that stock dips to $12 a share. Well, if my reasoning for owning that stock is still valid, I still think that there's potential in that company, I'll buy more. Because it's cheaper, right? It's at $12 a share before it was trading at $15. I used my connections that I had. I asked opinions of those with expertise that I lack. My grandfather was he was a CEO of an energy company back in the day, so I asked him about energy companies, what he thought the best values were. And my uncle, he's a CEO of a tech firm right now, so I asked advice from him. And then I wanted to not be shady to my investors. I wanted them to trust me, to continue giving me money, because after all, I don't have a hedge fund if I don't have their money. So I decided I would frequently update my investors on my progress, my future plans, what the fund held at the time. So I'm just going to say what I own. I don't have time to say why, but you guys can ask later if you want. Ford Motors Corporation, you guys know, it's a car company. Cheniere Energy, which is a liquefied natural gas company. Genworth Financial, which is an insurance company, mortgage insurance and long-term care. American Eagle Outfitters, you guys probably know, it's a clothing retailer. And finally, I went what's called short on GameStop, which means that I invested in such a way that I expect the value of the company to actually decline. I want the stock price to go lower, and I'll make money off it, and I can explain that afterwards. So that's about it. Thank you guys very much. Hope that wasn't too much.